Now call to order the special meeting of the Budget and Finance Commission for April 22nd, 2021. Marnie, can we have a roll call, please?
Can. Commissioner Johnson?
Present.
Commissioner Woodham?
Present.
Commissioner Marion? Commissioner Wynn?
Here.
Commissioner Solomon?
Here.
And Chairman Conroy.
Here. All right. Next, please join me with a salute to the flag. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. All right, next item is approval of the order of agenda. Would anyone like to change the order of agenda? Seeing none, may I get a motion to approve the order of agenda?
So moved.
And a second?
Second.
Okay, we'll do a roll call vote. Let's see, Commissioner Samples, I see you there. You gotta unmute. All right, Commissioner Solomon. Aye. Commissioner Woodham.
Aye.
Commissioner Johnson.
Aye.
Commissioner Marin. Commissioner Marin, I'm sorry. Okay.
Aye.
Thank you. Commissioner Wynn.
Aye.
All right, chair votes aye as well. Thank you. Okay, blue folder items. I didn't see anything. Marnie, are there any other items you are aware of that we will be reviewing tonight not currently included in our agenda?
Yes, so there's a PowerPoint presentation. We'll send it to you so you have it for your reference. But if you could receive and file that as a blue folder item, that'd be great.
All right. Okay. In that case, can I get a motion to accept that PowerPoint blue folder item, please?
So moved.
Second?
Second.
All right, and get a roll call vote. Let's start with Commissioner Solomon. Aye. Commissioner Woodham.
Aye.
Commissioner Johnson.
Aye.
Commissioner Samples.
Aye.
Commissioner Marin.
Aye.
Commissioner Wynn.
Aye.
Chair votes aye as well, and so filed. All right. That brings us to our consent calendar. Only one item on the consent calendar this evening. Would any members of the commission like to pull this item for discussion at this time? Okay. In that case, do we have any public comments on the consent calendar?
No comments on Zoom.
Okay.
We do have one e-comment. This is on public participation. This is from Imelda Shonok, and her comment is, South Redondo Beach needs to take responsibility for their fair share in housing. They need to zone more of the housing. It has to be equal and fair between the north and south.
All right. Thank you. All right. Can I get a motion, please, to approve our consent calendar item?
So moved.
And a second?
Second.
All right. Seeing a motion and a second, do a roll call vote. Commissioner Samples.
Aye.
Commissioner Wynn.
Aye.
Commissioner Solomon.
Aye.
Commissioner Marin.
Aye.
Commissioner Woodham.
Aye.
And Commissioner Johnson.
Aye.
Okay, chair votes aye as well. Consent calendar items are now received and filed. Moving on to item G. We don't have any excluded consent calendar items, so on to item H. public participation of non-agenda items. This, now, Doug, did you say that that was what you read was for public participation? Item 8?
Yeah, sorry about that if I got that out of order. I thought we were doing that was part of the public participation. Correct.
That's fine. Then, and I'll just ask Marnie briefly, is there anything for item H, public participation on non-agenda items from through Zoom?
There is not.
Wonderful. Then we will, let's see. Okay, then we will also, I guess we'll need a motion to file that as well, correct, Marnie? Or I don't suppose we could use the last motion. Let's just go ahead.
Yeah, let's do it to be on the safe side.
Let's do it to be on the safe side, please. Okay, so with a roll call vote, we'll start with the Commissioner Wynn.
Aye.
Commissioner Marin.
Aye.
Commissioner Johnson.
Aye.
Commissioner Woodham.
Aye.
Commissioner Solomon.
Yes.
Commissioner Samples.
Aye.
And the chair votes aye as well. Okay, let's see. Next on our agenda are items continued from previous agendas. Would any commissioners like to recall any items from previous agendas for discussion at this time? Okay, seeing none. If there are no items from prior agendas to discuss, we will move on to item J, items for discussion prior to action. J1, discussion and possible action regarding underwriter recommendation for bond issue to refinance city's CalPERS unfunded accrued liability, which will be presented by Marnie Rulin, and I see we've got some guest speakers here tonight as well. So with that, I'll turn it over to you.
I do. Thank you. So we have been moving along on putting together the financing team. City Council, I believe not their last meeting, the one before, approved the Bond Council and Disclosure Council. And we have done an RFQ for underwriting services. Did interviews of the top firms, sent you all the responses received, which was a really good turnout of responses. And what we're hoping for is Larry and Dan from Cosmont Transaction Services are going to walk you through what got us here and through the interview process. And then what we're hoping for at the end of the discussion is for you to, staff has a recommendation, which will be in the presentation, and asking for your concurrence with that or your alternative recommendation that we will then pass along to City Council and get their blessing on it. So I'll turn it over to Larry and or Dan.
And Marnie, am I able to share the screen here?
You should be able to.
Okay.
Good evening, everyone. This is Larry Cosmont. Good to see everyone again. And of course, Dan Masiello and myself are here to make this presentation, which is, I think we go to the next page, really to provide the summary of our recruitment process and selection process to field the best team that we can to round out the financing team. As you know, the financing team includes your municipal advisor, which is Cosmont Transaction Services, Disclosure and Bond Council, which have now been selected by the City Council, Norton Rose and Richards Watson. And the significant last piece, not all, there are some minor other players that show up in the transaction, but the significant balance of the team is really comprised of the underwriter or underwriters in this case, because we are recommending two firms given the size of this particular transaction. really the point tonight is twofold. One is to get direction to move forward to the City Council to continue to explore the UAL refinancing options with the finance team in place based on a selection of two of the underwriting firms that we will talk about, Stiefel and Ramirez. And I want to underscore that in this particular case, and I think as a result of the extensive conversations that we've had with the commission and with the City Council, Dan and I and Marnie really went out of our way to expose the RFQ for underwriting firms to a very broad base of the industry. 16 requests for qualifications. That's a very broad net for a local government financing initiative. We were given Redondo Beach's, excellent credit rating and stature in the municipal marketplace. And we are, in my view, a marquee city in California. Then 9 firms submitted SOQs and ultimately 6 were selected for interviews. We even expanded the interview basis because we wanted to make sure that we covered the gamut of possible firms, those firms that were very specialized and focused on California NPOBs or LRBs, both. We had no bias because we're still evaluating ultimately the best way to go. The second thing is, are they large or small, their financial capacity? We wanted a cross-cut of qualified firms that fit all of the various food groups, if you will, so we would have the best choices. And we enlisted Jerry Woodham's help and put him through a very long day. I'm surprised he's not taking a nap right now because we worked him really hard the other day. And we had about 7 hours of interviews and work together to give you the results that Dan is going to unfold for you. And I'll come back as needed to help Dan on the presentation. But I think we only have good news for you tonight based on what Cosmont saw in the interview process and the identified recommendation that we'll make to you tonight. I think it's very productive, very beneficial, and a positive result. So Dan, I'm going to turn it over to you.
Thanks a lot, Larry. Good evening, commissioners. Happy to be with you again virtually. As was mentioned, we solicited interest from a very large pool or contingent of underwriters known to us to be qualified to submit a response. And these are some names that are known nationally, of course, and maybe some that you don't recognize. We received 9 back, which made my life a little bit busy for a while there. I had a lot of reading to do and happy to do it. And I was really encouraged and enthusiastic about this turnout for the city. This is important financing for the city, and we want to make sure we get it right. And as you can see, of the 9 firms that responded, the ones with the check marks next to them are the ones that through the analysis, we determined would be a good idea to actually take it a step further and interview. And as Larry mentioned, we were actually going to have that a little bit less of a list. And after consulting with staff, we ended up expanding it to 6. So it made for a very long day on Tuesday, but it was well worth the time, I believe. And so we're going to just give you a quick overview of kind of the process, that we undertook and how we arrived at our decision, and then give you some time for some questions. So, as we said, we believe.
Could I ask a question? It's Steve Johnson.
Yes, please.
Thank you. Can you go back, please, one chart? So, of the firms that did not reply, were there any that surprised you that they did not reply, and were there any that you would have expected would have been a top contender who didn't reply?
I was surprised that anybody didn't reply. It's a $200 million deal potentially, right? So I really expected that most people would jump at it. But other than that, not necessarily. I mean, I don't know what is on the plates of the various firms, for example, that receive qualifications. It's a busy time out there. A lot of cities are doing projects. I thought maybe you'd get some interest from like a Union Bank type or a Morgan Stanley in addition to the other firms. I got a call from somebody at UBS and ended up speaking with them for like 20 minutes. And I thought they would submit a response. But at the end of the day, they had indicated they were not sure how they'd stack up because they hadn't officially done any pension obligation bonds. They do a lot of taxable bond financings. And I had encouraged them to submit a response because we were expecting at that time that we weren't going to just choose one bank. This is a lot of bonds, and we thought there would be at least two, and we would certainly be interested to hear from a talented and qualified institution that could help us out with selling bonds. And so maybe that would, I think I was most surprised by UBS because they called, just on that note. But in terms of the other firms, I suppose it's possible that they just were, a little busy or didn't have the right team in place, or I couldn't tell you why they didn't respond. Some firms responded and said thank you, but no thank you, and some just didn't respond. Mostly it was just some that said thank you, but no thank you.
I would add that one firm did call me directly, and I don't want to mention it, but they were a major firm and just said they didn't feel they had a POB team in place with sufficient experience. That was the one, I got that feedback, and I don't want to disclose who it is, but it would be a household name, and you would know them for sure.
Exactly. So that could probably, account for many of the reasons that, these investment banks are obviously real busy, and their time is money. And so to the extent they have to kind of handicap the requests that they respond to, and they have to feel they have a pretty good shot at winning to invest the time and effort into writing a proposal. So, or an SOQ. This was deliberately and specifically not a proposal. We'll get into that in a minute.
Great, thank you.
Sure. So as mentioned, this was in fact a request for qualifications. We wanted to steer away from the notion of a proposal because that indicates a bid, and we wanted to understand what a firm's qualifications would be. What do they bring to a process that would enhance and add value to the city's bond issue that it's considering? So that's how the RFQ is structured. There was in your agenda packet, I believe, the written summary that we provided to staff. And so the questions are both in there as well as an appendix A to this presentation, which you will receive after this meeting. But basically what we were trying to, figure out was, the firms that are responding, do they meet a minimum set of qualifications, kind of document that. We already knew they probably would, but just to put it in writing. And do those credentials that the firms possess comply with certain metrics that we felt this would best serve the city, such as the size of their capital base, do they have a California presence, those sort of items. And from all that, we were just trying to see what specific and unique value they might bring to the city's financing. So as you might suspect, the 9 firms that responded, in fact, all meet these minimum requirements. Any one of them could have capably underwritten or do the city's bond deal either on their own or as a team. And so we felt it was sort of our job to pick the best of those and maybe match up the best of those to get the city the best results. But the city, I thought, was in a very good place. It was a good situation to be in where you had your pick of the litter to choose from. So the firms that were selected for the interviews came from, the next step in our process was to determine who should be in the interviews. And we prepared a summary of the underwriter statements of qualifications, as we mentioned, and prepared that and had a meeting with staff. We met with Marnie and Assistant City Manager Mike Witsansky and thoroughly reviewed the contents of the SOQs and the nature of what each of the investment banks brought to the table. And the way we tried to determine who was the candidates we wanted to actually speak to was based on the comprehensiveness of their responses to the questions in the RFQ, their demonstrated financial capacity and technical capabilities. Some firms had much better responses and just raw experience at managing or dealing with unfunded accrued liability financings, whether it be a POB or a lease revenue bond. And just their general overall issuance experience for working in this area. So we did, in fact, hold those interviews last Tuesday, as Larry mentioned, and Commissioner Woodham joined us, and we're very glad he was there. He brought an excellent depth to the conversation. Although, that was a marathon. We were definitely on the video chat for quite a while. So it was Commissioner Woodham, Finance Director Ruland, Larry, and myself conducting the interviews. And they went very well, and we were very happy with the results. And we drew these conclusions from both the statements of qualification and the interviews combined. We had kind of figured before going into this, unless we were convinced otherwise, and we weren't, that the city really will be better served with more than one bond underwriting firm for a number of reasons, both technical and just kind of practical. $200 million, it's not the state, it's not $1 billion where you get 30 banks or 20 banks working on it, but it's a lot of bonds. And there are a lot of mechanics that have to happen to actually make those sales, make those trades, get that deal processed. And more than one firm helping out with that and covering various elements of the market would be better for the city. We believe that there would be much better market coverage with those additional banks, meaning lower interest rates ultimately. From the SOQs, there were two, in my opinion, and our opinion, and we expressed this to the city, and this came out through the interviews as well. There were two strong candidates that emerged pretty clearly from the pack, and those were a bond firm called Stiefel, Nicholas and Company. They usually just go by Stiefel, and Ramirez and Company. Based on our experience, we're recommending at this point that they should both participate in the underwriting, and we think it makes a lot of sense for them to basically split the responsibilities and the income on a 50-50 basis. So that will be known as joint senior managers. We believe each of these firms will bring excellent skills to the table, both in terms of intellectual capital, so to speak, and the distribution capacity we were speaking about earlier. They're both able to sell many bonds, and they're both very experienced in managing, underwriting, pension financing type of transactions, taxable municipal bonds, and of course, just municipal bonds in general. Of those two firms, one of them needs to actually there can only be one so-called book runner, somebody who actually keeps the sales book, allocates orders, does the mechanics of a bond issue, applying for CUSIP numbers, filing trades with MSRB, and all that sort of stuff. And so that's known as a book runner. Stiefel is a lot larger than Ramirez. Ramirez is a little bit more of a boutique firm, although they have outstanding experience and credentials. But our recommendation at this time is to appoint Stiefel as the book runner, just because somebody needs to be in the lead spot there. And having Ramirez on board, we think Ramirez had the excellent analytics, and they did a really good job explaining how they have a proprietary model to analyze all the UAL bases, how they would go about sorting through and determining based on certain criteria which base would be the best one to refinance if we go in a way that we don't do 100%. And so we felt that this team together was really going to provide just everything we were looking for to make sure the city has a successful bond issue.
Quick question, Dan.
Yes,
when you
please.
refer to we as in we felt this way, we thought this, are you referring to the body that you gathered on Tuesday, or are you speaking only about you and Larry on that?
Probably both, depending on the time. The underlying analytics that we provided to the team on both the city staff, being Marnie and Mike, and the commission on Tuesday, or the interview process on Tuesday. It started with Larry and myself performing the initial analysis, which we presented to staff, and then that initial analysis was modified per our. For example, we had suggested interviewing 5 firms, and after our meeting with Marnie and Mike, we ended up choosing 6. Little changes like that to kind of incorporate what staff really wanted to make sure that we included in our process, as well as ensuring that we had a very thorough, transparent, and far-reaching investigation of who would be the best underwriting team for the city. And it's also, I guess, a bit of the royal we too, right? So to make sure that I can't say I did everything here, and I certainly did not. But I think a lot of the nuts and bolts were performed by me, and then presented to both Larry and I. Would discuss, in terms of process, what we want to bring to the city, and then we would discuss and bring to the city with our findings.
And then Dan, also the choice of Stiefel and Ramirez after the interviews was, as you said, the 4 of us that did the interviews.
Thank you, Marnie. Yeah, that's absolutely correct. So we did the interviews on Tuesday, and after that long day, we were on the computer for another 20-25 minutes, if not longer, with the 4 of us being Commissioner Woodham, Marnie, Larry, and myself. And it was absolutely staff and the commissioner led the way in determining the 2 leading respondents that we're suggesting here right now.
And also, if I could add, after each interview, we had a structured maybe 5 to 10 minutes. The way we scheduled it gave us sort of downtime after each interview to figure out what we heard and align our thoughts about those, just so we could prepare a broader comparison at the end of the day. So we set up for that incrementally as we went through the day.
Was there some sort of a scoring checklist as you went through the interviews, or was it based on discussion afterwards?
Based on discussion afterwards, there were checklist items for us, like the quality of the team and experience of the team fielded, the depth of the response in the proposal and how it was articulated in the interview, particularly as to the analytics, right? So team analytics, and then market approach, the ability to get out there and mix it up in the market. And many of the firms actually fielded their marketing desk representatives, which was very interesting, because it's a lot of bonds, as we were all saying, and we want to know that there's an integrated team. Sometimes the desk is in New York and the team's here in LA. And so that coordination and market fluidity, if you will, becomes an important element. So, market approach dynamics, the analytic capacity, and the actual experience and personality of the team were really the three primary criteria that we looked at consistently across the board.
When you have the strategy of using two underwriters, do they, and this is so far out of my area of expertise, do they bump into each other in marketing the bonds, or do they sell to different markets? Is there an advantage, or are they going to compete against each other? How does that work?
That's a great question. So this is why one of the two firms is labeled the book runner. So yes, every firm that we interviewed, these bonds will primarily be sold to large institutions, large investment funds, mutual funds, and whatnot. And every one of these firms will have a person covering the exact same firm. Every one of these firms has a contact at Franklin Fund. Every one of these firms has a contact at Nuveen or Allstate or whomever is going to, solicit. So they absolutely will. So the idea here is it creates a little bit of competition among the firms in a friendly way, so to say, that each firm will submit their orders. And so for any given maturity, it could be that there are multiple orders. Now, what this will help with this process is that, let's say Franklin Fund, for example, they're both covered by both by Stiefel and Ramirez. The contact there would likely pick up the phone and speak to Stiefel directly, knowing they're the book runner, and the order will come in through them. But they might designate that order, and this is really getting into some technical back office type of underwriting stuff. But since they know they have their relationship with Ramirez and they also have the relationship with Stiefel, they'll call Stiefel directly and say, we want to, buy 10 million of the 35 maturity, whatever it might be. I'm making that up right now. But we want to designate half of that for Ramirez's account.
Sure.
But more importantly, since these are or joint senior managers, sales credit will be divided equally among each of the banks as long as they each meet their minimum liability, which is half of the deal. So, and that all gets sorted out in the process of the sale, and that is sort of the charge of the book running manager. They're the ones who have to allocate. So if there is a circumstance where there are oversubscriptions, there are more orders than bonds, then how that is handled will be a joint decision, but ultimately chosen or determined by Stiefel. And then the flip side, if there aren't enough orders, the liability will be split equally among each of the firms as well.
I just noticed two hands raised by by Commissioner Solomon and Commissioner Marin. I'll call on you, Commissioner Solomon, first.
Okay, thank you, Chair Conroy. Larry or Dan, your first two criterion were distribution capability and overall resources. You described Ramirez as a little bit more boutique than Stiefel, and in some of the other materials here, you look at it as though this is not looking like a retail deal, and you described it as going out into the institutional marketplace. It said that Ramirez did not have an in-house retail, but Stiefel had an extensive retail network. Are you looking at using both of them because they complement each other that way? That perhaps Ramirez is primarily operating in the wholesale market and Stiefel primarily operating in the retail market? It would be better to have the two of them working together. And the other thing about the distribution capability, if you describe Ramirez as a little bit more boutique, do we find that their distribution capability is then enhanced by Stiefel? Just want to get a little better idea of using the two underwriters, as Commissioner Johnson was talking about a moment ago. Are they used because they're complementing each other, or is there some other analytic that you were saying for these two particular, one brings one thing to the table and another to the other to the table, and we're going to use the strongest parts of both of them, and that's why we're going that way?
Yeah, that's a great question. There are yes and no. I mean, it looks like the way this is shaping up, it wasn't a deliberate, intentional. Let me back up a step. We wanted to make sure that the team had deep pockets, let's say, that we had a large bank able to, just through its market capitalization, help with distributing the bonds and potentially taking down bonds, meaning that if there are unsold balances, when we have the bond sale and, let's say 75% of the bonds are sold and 25% didn't sell for whatever reason, we wanted to know that the team would have the wherewithal and capacity to buy the bonds anyway and then ultimately sell them off on their own after the fact, locking in the city's interest rates. Usually that is a function of several things, one of which would be the cushion the city the investment bank might have in terms of their gross spread, which we're about to get into, that to assist in the, that's if they're long the bonds on pricing day and they bought bonds in the declining market, they are exposed to losses. So if they have a little bit of cushion in their gross spread to be able to manage that, it aids in setting the city's interest rates or locking them in instead of saying, we have to work longer on this bond issue. To your question about wholesale, as you said, versus retail, I'm sorry that I'm throwing some jargon around. I guess it's a bad habit. When we say retail, we mean the actual buyer, meaning like, we call them also mom and pop, maybe individuals who would want to buy bonds. The retail market has shifted over the last 5-7 years from what used to be a traditional, which is what Stiefel has, what you referred to. They have actual stockbrokers. Well, stockbrokers is kind of a misnomer. They sell securities. They're securities brokers, and they sell bonds too, right? And so Stiefel has a cadre of traditional retail brokers. You would walk into your guy, your girl, your broker, and say, hey, I want to buy some stocks. I want to buy some Redondo Beach bonds. It's unlikely because of the sheer size of these bonds, the maturity size, what they call lots, large block lots, they're going to be very attractive to serious institutional buyers that want to buy no less than $1 million and usually at least $5 million at a time. So when your maturities are $5 million at a time and greater, you attract an entire different category of investor. To aim these specifically at the individual buyers that might be buying $25,000, $50,000, $100,000 at a time for their retirement portfolio, it's going to take a very long time to sell $200 million of bonds that way, and it's a little bit inefficient. So what ends up happening, the benefit for a firm like the Stiefel to have the retail is they might lean into it a little bit and feel a little bit more comfortable. They wouldn't actually have pre-sale orders from the retail, but they really like the name Redondo Beach and they want to have some for their own inventory on purpose. And they want to actually buy some and then eventually, as a means to maybe do other business with other clients, however they're going to work on their relationships internally, they'll start calling their client, hey, I got a block of Redondo Beach bonds. These are a great buy. Do you want to buy 50 grand? You want to buy 100 grand? It'll be really good for your daughter's college fund, whatever they're going to do in that case. And so they might want to own the bonds. And so that's the benefit of having a Stiefel on board. Having Stiefel on board in that sense. But how those are actually sold, there's no distinction in price. They're all sold at a list price. That is the pricing set on trading day. There's no sort of actual distinction between it's not like a wholesale or a retail that we might think of in like markets in terms of like buying goods. So sorry if I was a little confusing.
No, you actually answered the question because I was thinking on the retail side. I mean, this is my dad did this for 30 years. He was the investment banker sitting on the bond desk.
Great. Okay.
So,
Sure.
so he was that guy that was selling the $100,000, $500,000 lots.
Right. So he was talking to the institutions, right?
Right.
He was on the
So
desk.
if you've got issue left over from the big from the big wholesale houses, from the big institutionals, then that's where you're going to go find some of the retail stuff. I expected we were going to go and look for doing this in big blocks like you just described, and where Ramirez doesn't have in-house retail, but they're not going to be the joint. They're not going to be the joint senior manager. And then I was just wondering how you determined that, and you answered the question.
And so the other, well, let me just add one part I didn't quite get to, and thank you for that, is retail has changed from the individual broker relationship to what's known as SMAs, and they're called separately managed accounts, where it's kind of like bundling. And so Ramirez has strong relationships with, it's more of an institutional trade type of feel, like you said your father was doing. But they'll be talking to one person to buy the bonds, and that person they're speaking to has intentions to sell it to 25, 50, 75 different people whose accounts that person is managing already, and probably has some sort of discretion to fund those accounts. So those are individual retail accounts where the bonds will end up, and Ramirez has relationships in that department, and that's a strong distribution channel of theirs, because that has, the market has shifted more in that direction. It's a little bit expensive. All the individual brokers now, I mean, people who have that sort of account, they're all Charles Schwab and E-Trade and things like that.
Yeah.
They don't call your corner stockbroker anymore, or as much. And
now it's people going to the sales meeting at their investment house, and they say, okay, these are the issues we have today, and this is what we want you to sell. That doesn't happen really anymore.
Not as much, and it's unlikely that will be the case here. Usually that sort of marketing approach and distribution is for difficult credits. It's going to be a hard sell. We have to take a long time to explain to people they're going to be sold in smaller pieces, $5,000, $10,000, $25,000 at a time. We don't expect that here. As a matter of fact, it would probably be pretty hard for an individual to get their hands on these bonds. They're going to be so popular.
Right. Okay. Thank you.
Sure.
Commissioner Marin.
Off the back of the interviews you did this week, I guess how aligned or not aligned is the recommendations or approach from Stiefel and Ramirez? Are they kind of in line or consistent in terms of the recommendation or approach in terms of what percentage we should fund, or a POB versus LRB? How aligned are they?
Larry, you want to take a stab at that one?
Yeah, I think, part of we liked this combination of the team because they had experience at both ends of the market, the POB and the LRB. And I think they also recognized that the spreads between LRB and POB had really tightened. So I think they were very aligned, Mr. Commissioner, on the fact that the next step of evaluation needed to be efficient and comprehensive. In other words, if we could underwrite and get the valuations for the LRB and get to speed to market because of that, that seemed to be the edge. They shared that opinion. And we do too, by the way, right? But to the extent that, we needed a sort of a backup plan, if that becomes the first opportunity, then I think we're pretty aligned that we ought to go secure that backup plan as well. So, they were, I thought, they saw the market very, very similarly, and they saw our circumstance in the market very similarly as well.
Yeah, and if I could just expand a little on that, one of the questions we asked was what, the city hasn't determined what percentage of the UAL it wishes to refinance, and how would you, what do you suggest? How would you go about helping figure that out? And by far and away, Stiefel and Ramirez both had the most comprehensive answer and capabilities to assist in making that determination. Some firms just said, "Oh, you should do all of it," and that was their discussion. So guess what? We didn't interview them. That's kind of how we figure that part out. And just a note on the distinction between a pension obligation bond and a lease revenue bond. At the end of the day, these are both taxable municipal bonds, which is really the product that needs to be sold. This is really what has to be distributed and find the proper investor for it. The distinction between pension obligation and lease revenue ends up being a little bit of a security distinction within that overall, genre, if you will, from the point of the investor. What are they comfortable with? Do they want that general obligation, or are they comfortable with the lease arrangement and all the distinctions that might come along with? So when we had the more difficult of those two to sell, and it's not by leaps and bounds or anything, but if you had to call one easier and one more difficult, the lease revenue bond is slightly more difficult sell. So if any of these firms are able and demonstrate capacity and capability to do the lease revenue bond, they're absolutely going to be able to do the pension obligation bond satisfactorily as well.
Correct.
And when you said like speed to market is critical, like what is the time frame around, or what is speed to market?
Well, first of all, we're very pleased that the city council got the legal team in place. That was one big step that we needed. If we can move on these recommendations, and no pressure here, it's just you asked the question, if we can get going on these recommendations and start to and go to council, and they're of the same perspective that they'd like to move in the direction we're going, then we've got, I think 7 weeks, 8 weeks of pretty hard, heavy lifting to get through the issues of valuation of the assets as commensurate to the debt, the level of debt we ought to take on based on a very comprehensive bases analysis of all the little tranches of ULL obligations and the timing related, some are short, some are long term, the vicissitudes of the market as they're playing out in real time for us, any prediction as to what CalPERS will do on their investment rates for next year. So we got, 3 or 4 key elements that we have to evaluate over a next 8-week period if we're going to really get to market, by June. And so that's why every day for us, it counts at this point. And so I hope that answers your question, but that's what we're doing.
So you're still, but again, the target is really trying to get this offering out in June.
To really move on it. And there are some pretty, deep holes we've got to go down here to really, secure a clear path of recommendation on approach ultimately.
Thank you.
Commissioner Samples.
Thank you, Mr. Chair. So I'd like to drop back to a basic for just a minute or two. First of all, both of these firms appear to be very capable, but big part of this discussion has been about their respective abilities to reach into various markets, have access to various markets, and be able to sell this product. And I realized in the material that you sent us that the lead banker for Ramirez was also, or was previously, the California Public Finance Group manager for Stifel for the last 7 or 8 years. An awful lot of what you're talking about in terms of reaching into markets and those relationships are based on personnel. Did you explore that with Stifel? Do they actually have the ability to do what they're talking about now that their lead person has left? And what does that do to Ramirez or their ability to be even a better resource for us than this split operation that you're talking about?
Yeah, I could just answer that a little bit. Mr. Sample, we know these firms quite well, and the bankers that are at Stifel all worked in tandem with the one individual that moved over to Ramirez. They're all very in-depth, highly experienced bankers. So Stifel actually fielded their 2 senior bankers in the public markets on this team. They're both going to be representing the deal. So we were and we know them and have worked with them on other issues. So we were very, very convinced and comfortable that, there is no shift or loss on the Stifel side. They just have a very deep bench. And of course, in the case of Ramirez, they got, I think, a very significant banker that moved from Stiefel to Ramirez. So in a way, we're the beneficiary of both sides of that equation. That's how we saw it.
And the bond underwriting firm really provides two services. The so-called banker, the folks they're going to manage the transaction, that are going to assist in ensuring that the legal structure is put together in a certain ways. They're going to help analyze the different UALs. Those all happen at the banking level that we would work with on a day-to-day basis. And at some point in the process, right as we get to the bond sale, the investment bank, their trading desk, their sales and trading side kicks in. And that's the side that would access the market, that has the access to the relationships in terms of investors and whatnot. And those individuals, are not, as Larry mentioned in our interviews, each of these banks brought their senior underwriter to the interview, which was very helpful. And that individual would be the one who has the authority to commit the firm's capital on any given day. And so they're the ones who are overseeing all the activities of the institutional salesmen and that are salespeople that are reaching out to the individual buyers that we're trying to, or investors that we're trying to attract to the bonds. And then that head underwriter is the one who says, okay, these are the rates we're going to offer the city. And, oh, we didn't sell all the bonds. I'm going to commit our capital anyway. I'm going to buy them. So those individuals are involved in the transaction really for like about 2 to 3 weeks, and the bankers are going to be involved in it for 2 to 3 months from here on out. And so in terms of distribution capacity and one banker leaving, zero impact. In terms of intellectual capital and ability to help structure deals, the people at Stiefel is, and another reason we wanted to use them, they have a very deep bench. They're a large firm. They have a lot of talented bankers. And Sarah Brown, who's the lead banker on this, who would be the lead banker on this transaction, should you agree with the suggestion of Stiefel, she's in the middle of several pension bond deals right now, one in Manhattan Beach, as a matter of fact. So it's an embarrassment of riches almost. We got the best of both worlds here.
So you're confident that even with this shift in personnel, this hybrid approach or the dual underwriters approach is really the right way to do it?
I think, moreover, that it's actually just luckily, and this wasn't actually part of the calculus, now that you mention it, maybe it should have been, but the fact that Mr. Amezcua moved, has relationships with his old firm, I think that the actual transaction team is going to get along very well. Everybody knows each other. So it's really going to actually be quite a smooth process, I think, as well. Kind of an added bonus.
Okay, very good. Thank you.
You're welcome.
Guys, I have just a couple more quick questions for you, please. And I think Dan, you just answered one of them. And with Commissioner Sample's questioning, is why would we have two? Is there a real advantage to having two as opposed to just the one? And it's the impression and the recommendation, it seems like, is that there is a real advantage to having both of them. And when you talk about the sales team looking at it one way and the underwriting team looking at it another way, on the sales side, they want to try and get what's best for their client who's buying, and on the underwriting side, we're looking to try and get it out the lowest cost to us. Which brings me to the underwriter fees you talked about, somewhere around the 2.5 to 4 range, but that's not the only impact on cost. You've got maybe underwriter's discount, you've got whatever the coupon is going to be. So was there, in your discussions with the two houses, to use Commissioner Marin's term, an alignment there as far as what they felt like their discount fees would be and where they were looking at what the yield might be? Or
I'm sorry.
Go ahead.
That's a great question. So I'm a former investment banker. I was an underwriter. I was an investment banker for about 13 years here in California. Before I joined Larry's firm, and before we, started building out the municipal advisory practice when municipal advisory activities became regulated. And so I'm kind of on the, I'm familiar with being on the receiving end of that. And this RFQ, and Larry and I talked about it, and we agreed, and we specifically designed it. We did not ask for a fee quote because we wanted to understand the dynamics of how they would go ahead and what were their actual qualifications, what makes them good bankers, what makes them good salespeople, what makes their desks able to distribute the paper. If we had a bidding war on the front end, and this is an excellent point you're making, and I want to address directly, is that let's say everybody wants to do this $200 million deal. And let's say the firms, we ask for prices and everybody said, okay, our gross spread will be $1.50 or $1. Okay, wonderful. That sounds great. Nice low bid. How can you go wrong with low bid? Well, when that deal shifts from banking to sales and trading, and the old joke we bankers used to make about the salesmen all read from right to left, meaning they check out the sales credit and then they see, do I want to work on that bond today? Do I want to try and sell that bond today? So part of our strategies, we want to negotiate after the fact, after they're selected based on qualifications, what the correct and the proper fee level should be. We, of course, want to get the best deal we can, but where is that best deal? Is it in the fee or is it in 5 basis points on the 25-year maturity? And I'll tell you, 5 basis points on what's going to be probably a $30 million maturity or more that'll be outstanding for 25 years. That 5 basis points is going to be millions and millions of dollars in interest versus, a couple of $100,000 in the difference of an underwriting fee up front. And so, we'd like to have enough ability for the bank to have sales credit in there. And I touched on this a little earlier. If we end up hitting a market that might be a little rough and the sale's a little hard and the bank has to decide whether or not they're going to lock in the rates, even if they don't have all the bonds sold, if there's a little bit of sales credit cushion in there that the bank feels their position isn't so precarious, there'd be a better, they'd have more of a likelihood to agree to commit to underwriting the bonds as opposed to repricing them, which usually results in some problems. And so we canvassed each of the banks and said, what do you think the market is these days? And they all gave us this range of $2.50 to $4 a bond. And of course, any investment banker will tell you they'd like to get, $10 a bond, a full point or more. But, this is going to be a AA rated, hopefully maybe AA plus. We'll see what ends up coming out. But certainly in the category of AA, which is a very desirable bond. We're hopefully going to remain pricing into a technical market where there's a low supply of these bonds. Taxable municipal bonds that are highly rated are very desired right now. So we have a supply and demand issue working in our favor. The supply is very low, so demand is high. High demand drives prices up. Prices going up means yields go down, interest rates go down. And so that's what we're hoping to capture here in general. And I thought that the price levels in that range are very, very reasonable personally. But what we also intend to do as the next step in the process is when we talk to the selected banks, we want to see what the market is. And we're going to tell them, hey, okay, what do you think your discount should be? And give us a reason why. Show us the transactions. Show us some recent transactions that are AA plus rated taxable bonds and above $100 million and what those underwriting spreads were. As you can appreciate, the larger the bond, the lower the spread can be.
And so along those lines, this RFQ went out specifically enumerating lease revenue bonds. Would we see spreads very different? Should the council decide to do POBs instead of lease revenue bonds?
I don't think so, because again, at the end of the day, it's a taxable bond, and it's the distinctions between lease revenue and pension obligation are somewhat nuanced, and they're very similar, and it depends on the ultimate asset that we end up using if we do lease revenue bond. And then it also becomes a question of, theoretically, a general obligation bond should be a little bit easier, a little bit less costly to sell than a lease revenue bond. However, the pension obligation bond flavor of general obligation bonds doesn't have any taxes backing it up. It just means that you're allowed to sell this. It's just a California constitutional allowance. It doesn't have a direct pledge of sales tax. General obligation bonds are considered the strongest security because there's a direct pledge of unlimited property taxes, that can be pledged to the repayment. Unlimited ad valorem taxes. This won't have that. It will act very much like a lease revenue bond. It's a general fund promise. It's a moral obligation at the end of the day that the city would promise to repay.
And that doesn't lead to preferred pricing.
It doesn't necessarily lead to preferred pricing. No, if this was like your Redondo Beach School District GO bonds, for example, where they have a vote and people's taxes are increased, unlimited estimator amount to make those debt service payments, meaning that if half the property disappears, all of a sudden the other half of the property is going to have higher tax rates to pay the absolute debt service coming due. None of that exists in this case.
Okay. All right. Thank you.
And Mr. Saul, it's important for us to say that the leading with the lease revenue, that's a more nuanced analysis. So the POB is a little bit more vanilla. None of this is really vanilla, but in the world of flavors, we know for sure that we need the lease revenue bond evaluation and underwriting expertise. If you're in the PO business, you have the POB expertise. The question is how good at it are you in underwriting and helping us evaluate the nuances of pledging assets with different perspectives and reputations, if you will, in the marketplace.
Yeah, thank you, Larry. And it seems pretty clear that each of these interviewed houses has experience with both.
Right.
I just wanted to be as crystal clear as possible because part of our recommendation would also be, should it be lease revenue or should it be pension obligation? And if there were to be a difference in pricing, I'd want to make that crystal clear to everybody or be aware of it myself.
Correct.
Okay, so thank you for clarifying that.
Yes.
Larry and Dan, you mentioned briefly that the representatives from Stifel and Ramirez that you spoke to personality-wise or was also very positive and went into your overall judgment. Just quick question, were those people you spoke to, are those the ones that are actually going to be doing the work, or were they more like business development type sales,
The actual bankers, sir, the actual bankers.
Great.
In all cases, the actual bankers. And beyond that, just so you know, these are bankers that we were not only looking at from the perspective of you as our client that we have a fiduciary responsibility to, but you had the additional dimension of both Dan and I having worked with them in other circumstances. So we've seen them in action in either firm that they've been in, by the way. So you really have that as a backstop of understanding and knowledge on our part.
Thank you.
I know I asked the first question, and I know we probably need to let you guys get off your first chart, but we do tend to ask a lot of questions. But this is, I just feel like I'm at work. We won't let anybody get off the first chart. Hopefully I can figure out how to do the math here. And I think on 200 million divided by 1,000, the range on the fees, it's only $500,000 to $800,000.
Right.
That's right.
So, split between the two firms, the fees are really not very material here. So I get the point about having other factors being really important. By appointing two firms and then negotiating, that's a new approach to me. Do we lose leverage there, or certainly you're recommending that for a reason?
I don't think we lose any leverage, because here's what's going to happen. They can take it or leave it. Frankly, when we get to the point, if they start saying we want $750 a bond, $10 a bond, we're going to tell them, well, justify that. Show me the market. What are other investment banks getting? And at the end of the day, we have the power to put in the authorizing documents that will be drawn up, specifically the resolution, and we'll get into that in our next step slide, which is coming up next. But there are still a lot of decisions to be made. And at the point in time, if this keeps progressing, that the bond authorization comes before council, there are limits and parameters that are established, one of which would be the maximum underwriting discount. Most of that discount goes to sales credit. Most of that goes to the actual salespeople that move the bonds. And a small component of that is what's known as the management fee. So the people that we spoke to, the investment bankers, their departments get a piece of that overall fee, but not most of it, which is interesting. I think we can have a discussion about that. But we need to be able to actually have, and I spoke on this a little earlier, motivate the salespeople to work hard on this deal versus another deal that might be in their desk that same day,
right,
so to speak. And that's not to impugn anybody that, they're not going to, they're a bunch of lazy bums, but, human nature needs, shouldn't be ignored either. And like I said, people do tend to see where they're going to get the most bang for their buck. They come into work and how can I make the most money today? So we wanted to be realistic in the market and understand the dynamics of the folks that are going to be selling these bonds. And we gave them the opportunity to tell us what they thought they should get. And, you know, when I was a banker, you know, our goal was always to try and get about a point. You know, you want to make about a point on your deals, give or take, and that changes. So this is, you know, these are some low numbers without being in a bidding situation. My concern was that if we actually put this in more of a bidding situation, we would have seen $1 a bond, and then there's just no room for sales credit in that. And I don't know how motivated a salesperson would be on any given day to work on that bond. And moreover, that would limit the ability of the bank to take down bonds or buy bonds that aren't sold come pricing day. So we're trying to build a reasonable amount of, you get what you pay for in life, for real. And you know, this is absolutely a service as much as it is a competitive pricing arrangement as well. So, you know, do you want to have the real estate broker that's going to have the absolute lowest commission sell your house? Or do you want to have the real estate broker that's going to have a fair commission sell your house, and where everybody's going to be happy? And that means they'll work a little harder to get the better price for you, knowing they're going to make a reasonable amount of money, or do they need to get in and out of your deal? It's very similar corollary, I think.
Makes sense. Thank you.
You're welcome.
We can stay on this slide for the rest of the night. It's okay.
I see no other.
Don't
I see
tempt
no
them.
other. I see no other hands raised. So, gentlemen, if you'd like to proceed.
Well, these will be the next steps. So, Larry, you want to take us home here?
Sure. So, you know, we've appreciated the robust discussion, and we had a very robust day going through it, and I think this discussion reflects all of the, you know, considerations that we've gone through to get to our conclusion of appointing Stiefel and Ramirez as joint senior managers, which is what that should say. KTS, if you agree, and I think, of course, you should hear from Commissioner Woodham as well as from Marty, but if you all agree, then we would bring the presentation of these UAL refinancing options to the City Council so that we could update them on the process we've been through, getting the team together, which is first rate, we think, and then remind them that their consideration would be to direct us to continue to evaluate LRBs and POBs, because we've got a lot of work to figure out what's most available to us in an economically beneficial way, and also to figure out on an underwriting basis through sensitivity analysis of costs and returns, whether we ought to be at 90% or 100% and really scour through the basis portfolio with CalPERS. And, you know, certainly, you know, looking at preferred repayment structure, allocation of budget savings, and, you know, whether or not we want to cut the mountaintop off and have a stabilized payment, or do we want to move, you know, with the CalPERS, you know, allocation or fee or charge, and whether we want to take advantage of front-loaded savings versus overall. All of that is what has to be, you know, done in the next 8 weeks that I talked about, with a goal to get to the market, you know, in June. So at that point, we would have you know, if we get through that analysis and that second long bullet that I just went through, then ultimately, you know, we'll be bringing a bond authorization action to council, which would be very focused on the details of the specific direction and the basic details of the transaction, including the specific underwriter's discount as ultimately negotiated, the issuance size, and the estimates of costs, including all the legal documents that support going to the marketplace, the preliminary OS, the trust indenture, the lease agreements if it's an LRB, and of course the bond purchase agreement with the underwriter, and all of the continuing disclosure agreement details that are needed for the marketplace. So that's really it. The recommendation tonight to council, the council appearance, getting authorization to evaluate all of the various approaches and nuances over this next busy period. And then when we're done with that, to come back to council for full authorization to move forward on whatever basis we would have arrived at.
You know, and part of that analysis that you have to be undertaken really is a deep dive on what the viability of a lease revenue bond has yet to be determined. We have reason to believe that it's something that is able to be accomplished, but we really do have, Larry said, you know, going down some deep holes. We definitely have some deep holes to explore right now and understand if the city has the ability to find $200 million of assets to encumber. And it might be the case that, and we don't know this yet, but it could be that we don't have it. So we're going to do that step of the process really quickly to bring to council our findings. And I don't know if we're coming back to the commission or council how this is going to play out after tonight. But my point is that if a POB ends up being the proper way to go, we would want to know that sooner than later, because that's a 4-month process minimum. 3 months for the actual court and then 30 days for the challenge, assuming the court only takes 3 months. So we'd want to get that started right away, because we wouldn't be able to be in the market until the fall in that case. And, you know, I don't know where interest rates will be in the fall versus I do know where they are now.
Dan, can you give us a little bit of a walkthrough on the next 8 or 9 weeks if we decide to do an LRB, and if things work out as we hope? What time frame are we talking about? What happens in the next 2 weeks, the next 4 weeks, the next 6 weeks?
Sure. Well, the very next step is, I think it's on here, May 4th. We bring this conversation to the council, to the full council. And the council would, you know, either accept the recommendation or make another one or decide something else and appoint an underwriter, and say, okay, you know, underwriter, join the team, start working with everybody. And what would happen from, you know, the next day, literally, is if we were doing lease revenue bonds and we're proceeding forward at this point, that would begin the actual transaction process, which involves primarily putting together the underlying legal documents. And in this case, it would be the preliminary official statement, which is a disclosure document. That's actually already being worked on right now by Disclosure Council. We would draw up the lease and leaseback agreements and the indenture of trust, and they'd have to be circulated among the group at least once or twice to go through and make sure that all the provisions are correct, all the security features are in there and accurately expressed. And then we would need to apply for a bond rating. So we would have to go to the rating agency. So that whole first part of the process would take at least 3 weeks. And that's a quick 3 weeks. That's going to be, you know, very busy 3 weeks to have a set of documents going back and forth and drafted and research being done to compose them.
Pardon for interrupting, but the key question about whether we do an LRB or a POB is whether we have enough collateral, enough value in pledgeable assets, correct?
Yeah, recognizable collateral that's acceptable in the marketplace. That, you know, unambiguous collateral, whether that's a street and or a combination of street or other city facilities. You know, Director Woodham, is really collateral. Everything that Dan just said in the next 3 weeks, which that's a very busy week. I think 3 weeks. I think that could be 4 easily. We're already having our real estate analysts line up. You know, we've already lined up a title company. We're starting to line up our research on underlying fee ownership, because we need to make sure that we not only have sufficient value, but we have sufficient control, you know, of ownership, so that the pledged collateral is substantive enough to, you know, achieve the desired market result on leverage, right? So we've got that working collaterally, and those points will meet at some point in the 3 or 4 weeks. And to the extent that, you know, we can make it in terms of the valuation and the legitimacy of the collateral and the lack of cloud or concern or ambiguity, then we keep going. You know, then the next analysis is it, you know, is it 90%, is it 100%, which is a different sensitivity analysis, if you will, or a different underwriting set of activities that we would also be collaterally looking at. And then if that didn't work out for some reason, that the underlying valuations didn't make sense, then we'd have the backup plan of the POB, which adds time, but, you know, would bring certainty on the legitimacy of the debt for leverage purposes. So that's going to be a busy, I'd say, key 4 or 5 weeks to get all of that done.
And for the benefit of the commission, we had one of the 6 presenters who questioned whether we had enough value in streets. And frankly, I hadn't thought about it before that point. I assumed we did. That's the whole reason for there being some doubt now or some question about whether we have sufficient value. And if we have to go past streets, do we go to parks? What do we go to come up with that value to support a $200 million bond issue?
Right. That's exactly the issue. And frankly, we appreciated the input of that firm, but that was a point that we weren't going to necessarily make a big deal of at this stage. It's a little bit of a technical point that we need to do further research on. So that's why we weren't, having that discussion in this format, because we have our work to do still to kind of verify that. And so the issue in play is that whether or not, and we need to determine this, does the city own the dirt under the streets or not? And so we know the city owns the actual infrastructure of the streets. Does the city own the dirt? And if so, then, can we put a value on that? And that's what we'll be doing on a dual track with everything I was starting to describe in terms of the mechanics of the actual transaction. That's actually already underway, as Larry pointed out.
Right, and this was not a new issue for us because we worked on this 4 years ago at Harbor, we did the waterfront financing. So we were fully aware of the issue. The question is, how much value is left that is intrinsic enough so that we can leverage? And if not, are there other assets we have to group into? And as Dan said, that's a turn the corner. That's why it's the second bullet here. That's sort of when we turn the corner, we go to work on that.
Exactly. And so all that process will be towards building the authorization package to bring back to council. So we'd like to do that as soon as we can. And generally, I would say 4 to 6 weeks, we should be in a position to bring from May 4th. Oh, actually, the goal is going to have to be 4 weeks or less from May 4th to bring the package back before council. Because if we want to be able to price and close before the end of the fiscal year, and actually before the last week of the fiscal year, if we want to pay off CalPERS this year on this UAL, or wait until we get the new one over the summer. So there'll be about a 6-week delay, I think, if we don't make this window, which wouldn't necessarily be the end of the world. We could sell bonds, or at least revenue bonds, you have a little more flexibility. Pension obligation bond would have to be very precise, and we wouldn't be doing that by June anyway. So we would get that package to council as soon as we can. And most of the items in that package are what we would call form documents, form of indenture, form of lease, which have the basic structure and security features of the transaction that you would know, the council would know what they're approving. But there might be a few details that still haven't been worked out. Most importantly, most obviously, would be the prices and the dollar amounts. We hadn't even had a pricing yet, right? So all that has to get filled in after the pricing. But there might be a few tweaks here and there. The rating agency might say they'd rather see something that we would insert, add a security feature, but nothing that would change the scope and nature of the actual deal that the city would have approved. So that's kind of what all of our energy will be focused on after May 4th. And actually already currently, as I said, work's already progressing on some of these items. So the council would entertain the consideration of approving an authorization, I guess, in the first meeting in June. And then we would literally the next day publish the offering document and start marketing the bonds. And we would have a bond sale in the middle of June and then have a close. A little bit tight. The lawyers will have to work extra hard here, but usually you want about 2.5 weeks between the sale and the closing. Kind of like on your house, you have a purchase and sale agreement, open escrow, and then you close. A very similar process here. So, but it can be done. It'll be tight. We didn't get as quick as a start as we had hoped to get to here tonight, but here we are, and there is time, and we're going to give it our best effort to get there. But we still have some unknowns ahead of us, and some decisions still have to be made by this body as well as city council before we can definitively move forward.
I'm thinking now that we got past slide 6, we can really get some momentum going.
So we've been focusing on what the refinancing vehicle looks like and the timeline for that. But before we can get any of that going, don't we need to know how much we're planning on refinancing?
So no. You would get either, the lease revenue bond, you don't need to know until sale day, until the actual amount of bonds has to be determined. So it will be another item that's being worked on as we are building the sale package, the authorization package, and the credit package to put together. What the UAL is. You call CalPERS tomorrow and they'll tell you you owe X as of today. It's just like your car loan. They'll know to the day, oh, you're not going to pay us off until next week. Oh, next week it'll cost Y. They'll know that. And then...
So we know the whole number, or we can get the whole number, but the question that I guess I'm asking is, and once again, looking through some of the material, it looks like recommendations range anywhere from 80% of what that obligation is all the way to 100%. And I think that's part of our conversation also. Do we recommend to the city council that they look at the 80% side of this, or the 90%, or the 100%? And can you give us some feel, and especially Commissioner Woodham, you've been in these conversations. Do you have any feel for what sounds like the most intelligent way to do this? And I'm not sure there's a perfect answer, but is there some level of wisdom that anybody can supply?
I can give you my opinion, and then Dan and Larry can give theirs. The key issue is the trade-off is this: we could do 100%, and that would get us maximum dollar savings early on. The risk in doing 100% is that if in future years, in most of the years of this bond issue, if CalPERS in fact exceeds their current 7% actuarial assumption, then we have funded at 100%. And if the returns are higher than the assumption, then we end up being overfunded. Now, in a perfect world, if you're overfunded, which means you've financed too many bonds, too much in the bond issue, and you'd like to have done less, in a perfect world, that would be balanced by paying less for the regular pension fund, the normal cost. But with CalPERS, we don't have that option. So if we funded 100%, and if returns are higher than 7, then we have an added expense that we hadn't calculated just because we're overfunded. So the proposal to go with 90% is simply to hedge the possibility that CalPERS makes more than 7%.
If I can just add on to that, the 2020 fiscal year of CalPERS did not hit their 7% mark. So the UAL we know today that we'd be trying to pay off before July 1st, the minute we pay that off, a couple weeks later, CalPERS is going to tell you have another UAL, and I'm going to guess it's going to be on the order of a couple $1 million, 1 or 2, I don't know. That's just speculation, but there will be a UAL, right? So by definition, you won't be refinancing 100% of what you owe CalPERS. At a certain point in time, it'll look that way. So there's a new UAL coming, but then on the flip side, to the commissioner's point, the current year is looking very good. I think, what was the number, Larry? Like 12%? I think they're
12 to 13. Yep.
They're on track to earn right now for this year. And so what that would do is would offset part of the UAL from the year before. And oddly enough, CalPERS amortizes both investment gains and investment losses above their 7% threshold. So there could be a possibility that you are at 105%, 102%, 108% of what your actuarial requirements are. Is that a bad thing? I guess that's a policy decision for this body and the council to determine. Because again, will CalPERS have down investment years? It's a cycle, right? They have good years, they have bad years. They've missed their 7% in, 7 of the last 16 years, I think. But then the years that they didn't miss, they made, double-digit returns. And we still have this UAL here. So anyway, to answer that question, our goal our intention is with that bond authorization package at the latest and hopefully earlier. Matter of fact, let me back up a step. The calendar that we've sketched out is we intend to have another round of presentations to council to explain the math that we performed to determine the proper UAL funding. In other words, here are your options for UAL. Here's what we, the whole team with the underwriter on board. And that's why we want to have the underwriter on board, because they're going to have some horsepower to help us do this math. These are your funding options and potential outcome scenarios, sensitivity analyses along with those. If you do this level of funding and then CalPERS has a good investment year or okay investment year or a bad investment year for each option. So it's going to be kind of a heady, complicated discussion, but we're going to lay out the options as best as we can. Whether or not we have time for that presentation to come through this body first, I don't know. I think we'd like to, and I'm sure that you would like that as well. And I think we'll do our best to plan for that. That's going to be up to staff and whatnot, and just time demands. But in general, before we present the authorization package, the plan is, and this is all very compressed schedule, to have that conversation before that, so the council has an idea of what the idea is. But specifically, do we have to know that in order to price bonds? The answer is no. We can be 100% or less, and we can price it right on pricing day if we want. But we certainly want the city's direction and participation in that process.
Well, both of these companies have indicated that they have some unique skills in being able to kind of optimize the proportion that gets funded. So yes, I think that would be very good information to have before we ultimately settle on what we're going to do. And it does sound like something less than 100% is the intelligent thing to do, but I don't know where that goes.
Not what we're doing today.
So, a couple of observations and a couple of questions, please. One is, Larry and Dan, we had one meeting where we had a pretty fulsome discussion amongst the members of the commission about the level of funding, 90%, 80%, or so forth. And it was the consensus, I'm going to go ahead and throw it out there, and if somebody disagrees, please correct me, that we didn't want to do the 100%. And then for some of the reasons that Commissioner Woodham just mentioned, and some of the other discussion here, that it would be less than 100%. But we also determined as a body that we wouldn't be in the best position to ourselves make a specific suggestion to say, we think it should be 80%, or we should think it should be 90%. That was left for people with an expertise beyond what our collective expertise was here. So from that perspective, we all at that time agreed that it would be somewhere less than 100% and thought perhaps 90%, but didn't want to make a determination based on that information or that thing, feeling. Another thing would be with regard to the pension obligation bonds versus lease revenue bonds. You mentioned earlier in the presentation that the pension obligation bonds seem to be a little bit more attractive, but not enough to tip the scales. So if we went to look at doing this as a lease revenue bond.
Excuse me, Commissioner, I think we were talking about sales credit at that time.
Okay, all right.
Yes.
Fair enough. When we're looking at lease revenue bonds and determining whether or not there's enough collateralization going around the city for the streets and such, is that something that we're going to know pretty early on in the process, where if we had to switch gears to pension obligation bonds, we could do that?
Yeah.
Or
That's the goal.
Sorry, go ahead, Larry.
No, that's the objective, is to get to know that as early as possible. So in case, Mr. Solomon, we need to shift the program to focus on POB, we know that as quickly as possible.
I think that would be the presentation we would be making. It's either going to be, here are your payoff options, and here's what we're going to bring next council meeting for an authorization package, or at that meeting we'll have to say we need to pivot to POB at this point. And your next meeting, please do that. I think that's how it's going to play out.
You think you'll have that insight by May 4th?
Oh, no, not by May 4th. May 4th is just the selection of the underwriter. Hopefully by the middle of May, though. That's going to be the goal.
Yeah.
when it comes to the term of the bond, where we're looking at going out 20 years, 25 years, or 30 years, and one of these decision items here, which was the preferred payment structure, increasing or decreasing payments, how does the length of the bond or duration of the term affect that scale? Would it be much heavier front-loaded if we went out 30 years or 20 years rather than 30 years?
Yes. You'd have more payments. You'd save more interest overall because you're paying off your loan quicker. But your payments will be higher, just like your mortgage, which has higher payments, 15 years or 30 years.
So that's not one of the things here that's a decision item or an item for contemplation. Is that something that is hashed out through the process in conversations with the underwriter? What will be the best pricing? What will be the best for the city? Determining what our available collateral is, that kind of a thing?
So, the process here, Commissioner, is a lot of this needs to take place with us as your municipal advisor and staff in concert with the finance team. And so to a degree, we're going to kind of work through some of these options, and we will have, how do I put this? It's not going to be feasible to have a structuring by commission, literally, for the deal, but we do want to present to the city some kind of menu items. And we're going to have to determine, there'll have to be some level of pre-screening from your consultants and your staff to build that menu. But we will absolutely present, this is what it looks like, a 20-year repayment, 25. And generally speaking, I think it's pretty safe to say there's a repayment term right now. CalPERS has determined that you will be repaying your UAL over X years. I don't have it right in front of me. It's about 25. It might be 24, 26. I'm not entirely sure. There's nobody proposing to extend beyond that at all. So that's kind of our ceiling at the moment. And then, it doesn't make a lot of sense to show you 24, 23, 22, 20, see what I'm saying? So we're going to have some level of kind of filtering involved to present you some reasonable kind of signposts that you can kind of choose between. But we definitely want to make sure we illustrate. And in concert with specifically Finance Director Ruland, what are the budgetary considerations and constraints that are going to be in play? And do we want to save more money up front, or maybe more money in the next 5 years or next 3 years or next 10 years? Which is the most important period? Is there room in that period for debt service to go up a little bit every year so we can kind of keep ahead of the curve and pay off the bonds quicker? Or do we need to have that exactly level? Do we want to have a level payment and add debt service, add payments where there are technically none now? There are pros and cons to all those approaches, and we were going to try and distill them down to a few key menu items, as I mentioned, and present that to hopefully this body first and then council. I just don't know what the calendar is going to look like, but definitely council is going to have a direct say in that, regardless, of course.
Okay. Thanks, Dan.
Not just to get in the weeds, another factor is to the extent that we do 90% and you have certain, tranches that are longer or shorter in payoff, that also affects the way that you go on, selecting, whether it's a hybrid or a flat mountaintop and so on. So, everything gets thrown in the blender, if you will. Remember those charts we had that showed different payment streams? Well, in essence, we'll have a much more refined assessment of all those alternatives.
And that's an excellent point, too, because to the extent we don't refinance 100% and we leave UAL outstanding, we're going to want to structure these bonds around those other payments. And so the bonds might look a little weird if you looked at them in a vacuum, but that would actually be your total pension expense or the repayment of this UAL. So that would be a factor as well.
Well, that brings me to my next question, which is a question for Marnie and some mechanics here. Currently, what we do is we prepay our UAL for the upcoming year at the end of June, beginning of July. So there's two things here. One is that when we're talking about if we're picking increasing or decreasing payments, would we go to a level series of payments monthly, like you would do, say, on a mortgage or something like that, or would we continue to make a lump sum payment? And then the second thing is, Marnie, when we're looking at doing this, if we can get, well, in a perfect world, the lease revenue bonds are the selection, and it all works out and everything goes incredibly well, and we're able to do this in a short period of time. What's the recommendation for our payment that's due at the end of June to CalPERS? Do we make a partial payment? Do we make our full payment? Do we get a credit for it? What are the mechanics of that in interfacing with these bonds being issued?
So that brings me to a comment that I wanted to make. So as we went through these interviews, they all walked us through how they do their analysis of the sizing, of the structure of the bonds, all that. And Ramirez was definitely one of the top, if not the top, in having analytical tools that could do, basically every scenario. So those scenarios are also going to include what we do about the upcoming UAL payment. So as opposed to us needing to make it the end of June, we don't make that payment until the end of July. And in fact, we don't have to tell them what we're going to do. They simply know if we send the full payment, less the discount, by the end of July, that's it. If we make the monthly payment, then they'll start billing us each month. But we really will be looking to the underwriter for more in-depth analysis on that payment.
And that's actually going to also play into whether or not, a POB versus LRB. If you do an LRB, you have a little more flexibility. If you do the POB, when you go to the court to validate the outstanding debt, you can't have outstanding debt if it's been paid down, right? So if you prepay that fiscal year 21-22 payment before the end of July, that debt's no longer outstanding. That's less that you're able to refund. You couldn't recapture that. You have to pay the full amount of that amortization out of your next year's budget. And whether or not that makes the best sense for the city going into 21-22, I guess, we're going to have to work that out with Marnie as well. Was there a need to try and find some extra savings in next year's budget? And what would the ideal level of actual amortization payment be? And so if we went with the POB, we'd almost have to, I would think, start making monthly payments and forego that 3% discount in order to possibly realign the rest of the year's budget payments. Just another, item we'll be working on. There's a lot of evaluation we're going to have to perform here. A lot of analyses are going to happen. And that'll be one of them.
So one last comment and one last question, please. And thank everyone's indulgence. The last comment is, this is a lot of material, and I want to thank you, Dan and Larry, for distilling it down into a bite-sized but robust presentation.
Thank you for that.
We're always asking for more information, but you can get overwhelmed. And I think this was a Goldilocks version of that, in my opinion, anyway. The question I have is that if we fund less than 100%, or even if we fund 100%, there will be some years where we still might have a UAL liability because of CalPERS performance. So since I see some nodding heads, then another reason why, and we discussed it, it makes more sense to maybe do it for less than the full amount, because we would have some more flexibility in being able to accommodate or take care of those unexpected UAL liabilities as they come in, depending upon performance. So thank you. I appreciate the time.
One comment just to Commissioner Solomon's last point. Another nuance that we need to be aware of on this is that if you'll remember from the presentation we had by CalPERS, at the end of this year, September, October, November, they're going to be doing a new asset allocation study, coming up with a new actuarial assumption. The assumption is that that's going to be lower, but no one knows how much lower, if it is in fact lower. But to pick an extreme example, if they go to 6% instead of 7%, then on an ongoing basis, the bogey is to return more than that new 6%. So that will affect us in the future in currently an unknown amount and an unknown direction.
I think every expectation at this time is that it's going to come down. We just don't know how much.
Yeah.
What was the date that CalPERS is going to make that determination? Do we remember?
I think it's November.
Yeah, we heard both September and November on the call, so I'm not sure.
Commissioner Johnson, I saw your hand up earlier. Do you still have something or not?
Coming off mute. So we're going to be asked to approve this recommendation, and I think it was mentioned earlier that we might briefly hear from Marnie and Commissioner Woodham about their concurrence on this, as they were present at the interviews as well. So I would briefly like to hear their thoughts.
Yeah, I'll go first. I agree with the two that were selected. B of A and Stiefel seem to be the two large gorillas in the room that had a larger organization. And frankly, you'd be okay picking either one. The kind of things that impressed me more about Stiefel were one in particular. All of the things being equal, you're looking for someone who can market the bonds. They are the only firm of the 6 who suggested a somewhat novel approach of doing a 5-minute video of the city and using that as a marketing tool. That's, I think, a very interesting approach. And they have on their in their material, they had a couple of those prepared, so you can see how they did it for the city of Orange. So that's one of the reasons why I liked Stiefel. And then the combination of Stiefel and Ramirez, I think, makes a good combination. So you're clearly Stiefel could do the entire thing. We're betting by putting someone else in that we get a little competition and a little increased marketing effort, which benefits us from the standpoint of lower rates. So again, in summary, I do agree with two firms, and I do agree with the two that we selected or that we're recommending to the commission.
And I also agree with them. And, that's the conclusion we came to on that day, after interviewing all the firms. I think the two complement each other really well. A little bit different size, little different areas of expertise, as I mentioned, with Ramirez in their data analysis. I think they really excel there, whereas Stiefel probably excels a little more at the marketing. And I think it'd make a really good team.
All right, wonderful.
Well, I'd go ahead and make a motion then.
Well, I was just gonna
Go ahead, Jeff.
you were gonna make a motion to wrap things up. I was just gonna get to that, but before, I just wanted to formally ask if there's any other questions or comments from the commissioners.
I wanted to, before I forget, thank Jerry, Commissioner Woodham, for taking all that time and helping out. That was really great, and we appreciate your input here on the commission, and I'm very grateful that you were able to do that with the team, with the staff, the city, and with Dan and Larry.
Oh, and we appreciated having him on the team too.
What are the benefits of being retired?
It was really good. It was a really good day.
Absolute value added all the way. Really appreciated having me in the interviews. Thank you again for your time, Commissioner.
You picked the right guy. Thanks, Jerry.
Yeah, thanks to all of you, Marnie, Dan, Larry, Jerry, for putting that together, making that happen. That's fantastic. All right, I don't see any other questions or comments for Larry and Dan at this time. So then I'd like to ask if there are any public comments.
There is nobody on Zoom.
No e-comments.
Wonderful. With that, then, seeing nothing else for discussion, then I would like then I'll ask for a motion to receive and file item J1.
I think we want to make a motion to make some recommendations here based on the slide that was up there asking for our input.
All right, thank you then. All right.
Well, I would make the motion to use Ramirez and Stiefel as co-managers, that we pursue the lease revenue bond option first, that we recommend that the bonds, the UAL be funded at less than the 100%, but defer to the experts as far as the percentage, whether that be 80 or 90% of the UAL. And we didn't really address the idea of increasing or decreasing payments. I would make the recommendation of decreasing payments as part of the first consideration as well.
That's a pretty extensive motion. Is that, are we, that might help. I don't recall if we were supposed to weigh in on each of those individual items. Maybe we were.
We were hoping for just the recommendation about the underwriter.
Terms.
And
Okay.
That's what I
I think
thought.
the remaining decisions are made once we have the underwriter as part of the team and hear the specific recommendations based on their analysis.
I think, Dan, you had mentioned maybe even a menu approach that you were going to kind of put up for us to, either for the council or for us to review.
Okay, I'll withdraw my motion.
Why don't you just remake that motion in the form of the 200, the underwriters, shorten it to the first part of your motion. And that.
Okay, can do. I would then make the motion that the commission recommends the joint underwriting team of Ramirez and Stiefel.
Second.
Wonderful. Having a motion and a second, we'll do a roll call vote. Commissioner Samples, please.
Aye.
Commissioner Solomon.
Aye.
Commissioner Woodham.
Aye.
Commissioner Johnson.
Aye.
Commissioner Marin.
Aye.
Commissioner Wynn.
Aye.
All right, and the chair votes aye as well. The motion has been received. Or excuse me, this is, Marty, help me out here. With that, that's a motion separate from receiving and filing the item.
Really, the recommendation that we had on the agenda was for making for you and a recommendation to council.
Okay, so that recommendation has been received and filed, and no additional motion is needed for J1, correct?
Right.
Perfect. Thank you very much. All right. Again, with that, I'd like to once again thank Larry and Dan for the wonderful presentation. I agree, it was concise, yet very informative and fairly easy for people like us, not speaking for Jerry, to digest. So thank you so much for that.
You're welcome. Thank you for your time.
Thank you. Thank you very much.
Thank you.
Thanks, guys.
Good night.
Be safe.
Thank you very much. Good night.
All right. With that, we will move on to our next item for discussion prior to action, J2, discussion and possible action regarding the general fund 5-year financial plan assumptions for fiscal year 2021, 2022 through fiscal year 2025, 2026. Go ahead, Marty.
Thank you. So each year of late, we bring to you before a 5-year forecast is put together, just the basic assumptions under which we would do that forecast, assign the numbers to it. So at the time, it's just getting close to the budget being released. So it was time to put it on your agenda. But actually not until we did the interviews with the underwriters was I reminded that really these two items you have before you tonight are related. The forecast is something that we will need to present to the rating agency. It's something we, when we did our 2019 bonds, at that time we were not doing a forecast and were marked down for that. So we have been doing forecasting. We'll present it to the rating agency. And so the two items really go together tonight. So what we have is we break the forecast into a revenue section and an expenditure section. And then what's left off from these assumptions will more be determined by the assigning the numbers to these assumptions and seeing whether then we end up with an excess or a deficit, and then that'll determine what actions need to be taken after this. So on the revenue section, we call out individually the top 10 major revenue sources, and then a last one that groups all the other general fund revenues together. Then on the expenditure side, we make assumptions regarding our three main categories of expenditures: our personnel expenditures, our maintenance and operation expenditures, and our internal service fund charges. So we have before you a probable case, which at this point is our best guess at what the next 5 years would look like. Best case is kind of what we hope for, and worst case is what we hope will not happen, but potentially could. And so this draft will also be reviewed internally by staff, but we want to make sure that we get your input. You often have a different perspective than we do, so we want to make sure we get everybody's different view on the world and able to take everything into consideration in coming up with these assumptions. So you've had them in your agenda packet. So instead of going over each one of them individually, if you do have any comments or suggestions about these assumptions, love to hear them.
Marnie, quick question. This is not a question about the assumptions, but I should know the answer to this, and I don't. What are property taxes in lieu of vehicle license fees?
So it was a number of years ago, the state kept swapping out revenues that they would keep or they would distribute to local agencies. And, you know, they'd be restricted by law, and the state couldn't keep this type of revenue, but they could keep that type of revenue. So this was in one of those iterations that they did.
Okay.
And so they used to give us vehicle license fees. Now they keep that and give us this in the form of property tax.
Okay, got it. Thanks.
I guess I had a quick question.
Sure.
Looking at the assumptions, just again going kind of post-COVID and after South Redondo built out a lot of outdoor dining, specifically in South Redondo. Like when you start looking at, I guess maybe increased sales tax because of it, how does that look to possibly offset parking meters or parking citations? Like, has that been thought through, or I guess what's the methodology?
Yeah, so you'll see in the assumptions, I think it's with parking meters. It does take into account getting back the meters in Riviera Village where they had or still do have the outdoor dining spots. So we anticipate once those spots are back that it will.
But the anticipation is that the outdoor dining will go away and that the parking will return.
Yeah.
Okay.
Yeah, but our biggest factor in the parking meters really seems to be the meters that take credit cards. That seems to increase the revenue more than even these spots in Riviera Village.
Gotcha.
So Marnie, actually, since we're on that subject, has anyone looked into what the difference in revenue that we receive from those restaurants taking up parking spots versus charging $1 an hour for parking? Is there a value in that?
So comparing what? The loss of the spots?
The loss of the spots versus the revenue. Well, actually, I guess, does the city receive any revenue from those restaurants that are using the parking spots? And what's the difference between that revenue versus charging $1 an hour for the spot?
And you were talking sales tax revenue, right? And because that's really all we would get off from that. And so those outdoor those restaurants with those outdoor dining spots, HDL gives us a report quarterly on our sales tax revenue. And those restaurants in that area, we haven't seen like an increase over pre-COVID. So really, you're kind of dealing with unknowns. So we know what we did get, but we don't know what we would have had if they didn't have the outdoor dining, if they were doing takeout only. Since that didn't happen, we don't really have that to as a known factor to compare to.
Well, I think what I'm asking is, and we probably, first of all, it's probably lagging information, especially as erratic as this reopening has been.
Yeah.
It's like, what was the kind of historic or average revenue from the parking meters, say a year and a half ago or 2 years ago at this time of year versus is there a difference in the sales tax revenue that we get from the restaurants today versus that time? And it's probably an unfair question, but just wondered.
Yeah, so we aren't seeing additional revenue, but are we seeing additional revenue from what it would have been without them? And that piece we don't know.
No, I think because the restaurants aren't benefiting with additional capacity from these patios, is to make up for the lack or the loss of capacity with the social distancing inside or being able to serve inside at all, which has only just recently happened. So, yeah, to Marnie's point, I don't think there's enough data to really compare.
Yeah. And, one of the other things that you can't really quantify is, has this just helped them as opposed to generating so much revenue? Has this just generated enough revenue where they're not going out of business?
Yeah, or I guess even like on the go forward basis, that when everything fully opens up, will more people be going to restaurants and will there be increased sales if there were this increased seating outdoors versus Commissioner Sample's point? Is it better to take those parking slots back and generate the parking fee and citation revenue?
Is there a date, Marnie, that you're aware? Are they when they'll be dismantling or required to dismantle those patios?
Oh, I think there is, but I think they're requesting that it be extended. So
It could be in conjunction with or closely aligned with when the emergency order ends. And
absolutely.
The Coastal Commission would then come in and say that we allow these during the scope of the emergency order, but we are going to give you a hard and fast date now that that has ended to remove those or work out a deal with them. Marnie, I'm sorry, go ahead, Commissioner, Chairman Conroy.
Oh, no, I was just going to say, I thought it was great having the patio dining, and that I personally hope that even in better times after COVID, that the city is able to do some outside dining for maybe a couple months every summer or something like that. Would be great.
Yeah, absolutely. And a lot of the restaurants that I've spoken to, the business owners, it's been feast or famine. You know, they've had months where that period after Thanksgiving, end of November through January, was pretty meager times, and then pent up demand, people getting vaccinated, has exploded the demand for those seats outside. So opening up capacity, going to an orange tier is definitely going to help us. Marnie, I noticed the personnel costs. It's good news. Most of our or all of our labor unions are under contract. What is it, 3 years? Or is it?
Yes, and so all of our miscellaneous, that 3-year ends at the same time. Our safety, it's staggered a bit.
Okay, so that'll be pretty predictable.
Yeah.
Yeah, isn't that nice? A predictable experience is always helpful. I noticed, and I was thankful that you included, factored in the possibility of the additional TOT for the PV Inn when that opens. What I didn't see was in anticipation of any additional revenues for TOT for the hotel at the Galleria, or for increased possible sales tax when the Galleria remodels opened up, which I would think it'd be out by 25, 26 period that you had there. Was there a reason we omitted that? We don't know, we're not sure of it as a factor or consideration?
You know what? That is something that I will double check with our community development director. Just off the top of my head, I was thinking it wouldn't be within this time period, but I will double check with her and add it in if it is during this time period.
Okay, because I think they were going to put a hotel there as well.
Yes. Uh-huh.
Okay. All right, great. Thank you. That's all I have.
Hey, Marnie, when we talk assumptions, the first thing comes to my mind is let's be conservative with our assumptions. There's so much, the environment it's changing so much daily. Just a couple of questions here on the first slide. Property tax probable is 3% a year. Does Prop 13 limit it to 2% per year, or is there something I'm missing where we can, the extra percentage in property tax revenue? What's?
Yeah, just our historical has been more than the minimum of the 2%.
Probably because
Gotcha.
when properties change hands, they get reassessed. So you're going to get
Yeah.
up there.
So there's a slide here for real estate transfer fees. So the fee when we sell property, that's a separate category, right?
Right. So
Right.
you have the value that it sold for, comes into play in property tax. Property transfer tax has two pieces to it. It's how many properties sold during the fiscal year, and then on top of it, at what sales value that was, because we're getting, what is it? $220 per thousand, I think, of selling price. So both definitely come into play.
And then TOT, I feel like TOT really changes a lot for us. So I just want to clarify on the probable cause that we're banking that this year, 21-22, when you say 75%, that means 75% occupancy of the hotels. Is that what that 75% means?
Really, I'm taking it 75% of revenue. So again, there's two pieces.
Okay.
Occupancy is definitely the bigger piece. But just to attract people back to the hotel, there is a chance as well that they will lower their prices until they're back to quote unquote normal.
Yeah, those three hotels in North Redondo, Marriott, Homewood, Hilton, they're doing so well, and even pre-COVID did so well. So, and they're still even at reduced levels doing. It seems like talking to them, they're still filling up based on whatever occupancy they're limited to. So I'm optimistic that when June 15 comes and limitations are removed, those hotels will bounce back up.
Me too.
I think that's it for me right now while I look through the rest of these slides. Thank you.
Thank you.
Does anybody else have anything for Marnie as it relates to these slides and J2?
One other thing, I feel like this parking citations are flat. I feel like parking citations are always going up. Maybe I'm just getting more tickets than other people, but I don't know. I feel like it's always be going up.
Well, remember they suspended tickets for street sweeping for a while during the last fiscal, or during this fiscal year.
Yeah, and all these things have so many factors, even just our staffing of the parking enforcement division comes into play with, how many tickets can be written. And I know just really recently we had two of our parking enforcement folks leave the city. So we'll be a little while before we can hire replacements, and we'll just see how it goes.
I think that some of our parking meter revenues would go up with the automated or the change out of the parking meters where people were overspending hours on credit cards, where previously they were coin operated. Now, I thought part of the sale of the credit card parking meters was that we were going to have excess time being deposited or surplus monies going into there. That was part of the revenue enhancement of those meters. Yeah.
So one thing, since we were also talking parking citations, that we found interesting with implementation of the smart meters that take credit cards is just because it's more convenient to pay with a credit card, more people were paying as opposed to with the coins. They may take a chance. I'm not going to get caught because I don't have any coins that I can put in the meter. So actually our parking citations went down and our parking meter revenue went up.
Absolutely.
That makes a lot of sense. Whenever I go to a credit card meter, I always put more So it makes a lot of sense, putting more, less citations.
Like a little insurance policy.
Yeah.
I love that.
Yeah. That extra dollar will save you $75.
So we should take out the automated meters and start collecting the $75 parking tickets?
Is there some also effect of us contracting out some things, Marnie, that maybe is built into there where, for example, we were maybe going to hire out a firm to do plan checks for us or further automate plan checks?
On the parking enforcement?
Just in general revenue, maintenance and operations, where having automated plan check or automated permitting might save us on maintenance and operations.
Yeah, because those are kind of case by case, and we don't know of any at the moment that we're specifically looking towards. Haven't included any of that in the assumptions.
Okay, thank you.
All right, gentlemen, any other things, any other comments, questions for Marnie as it relates to J2?
You're muted, Jason.
Thank you. Seeing no additional questions or comments for Marnie, I will ask now if there's any public comments.
And there is nobody on Zoom.
There's no e-comments.
Thank you. Then is there a motion to receive and file item J2?
Motion to receive and file J2.
Second.
We'll do a roll call vote. Commissioner Samples.
You muted me.
Aye.
Sorry. We'll do a roll call vote then. Commissioner Samples, please.
Aye.
Commissioner Wynn.
Aye.
Commissioner Marin.
Aye.
Commissioner Johnson.
Aye.
Commissioner Woodham.
Aye.
Commissioner Solomon.
Aye.
All right, then the chair votes aye as well. Item J2 is now received and filed. All right, then with no other items before the commission, we will move on to member items and referrals for staff. I'd like to begin this time with Commissioner Woodham, please.
None from me, thanks.
Commissioner Marin.
Nothing from me.
Commissioner Samples.
I have nothing. Thank you.
Commissioner Johnson.
No, thank you.
Commissioner Wynn.
I'm good, thanks.
Commissioner Solomon.
I have a question and a request, please. The question is, Marnie, I know the money was approved to do a deeper dive with the actuary for the workers' compensation for the fire department. Has that study been completed, or is that in the works right now?
It is in the works.
Okay, thank you. And then a request for some time after the budget in the summer. We may not have the privilege of everyone's company, but when I first came on the commission, were visiting the idea of adjusting our cap for what is a capital improvement project, because it's in our municipal code and it's so low right now, and it's not been indexed for inflation. It's sometime in the summer, July, August, even into the fall. Can we maybe bring that back? I know Andy Wingy and Assistant City Manager Witansky made a presentation. I think it's worthwhile revisiting that and taking another stab at it.
Okay.
Thank you. That's all.
All right, thank you, Commissioner Solomon. And the chair has nothing for Marnie or staff at this time.
Okay, we'll make a motion to adjourn.
Before we adjourn,
Yeah.
I just want to remind everybody there's special joint meeting on Monday with the Public Works Commission. I'll be sending out the agenda tonight after the meeting. And if you will be attending, it's going to open as a Public Works Commission meeting first, and then it'll recess to the joint meeting. So at the start of the meeting, if you can all keep your microphones on mute and deactivate your cameras until you're asked to, or until it opens as a joint meeting.
And that's at 7 o'clock, Doug?
Yes, 7 o'clock on Monday.
Okay, thank you.
Thank you.
Thank you, Doug. Okay, then with no other items, I will entertain a motion to adjourn.
So move.
Second.
All right, seeing a motion in a second, we'll do our last roll call vote of the night. Commissioner Johnson,
Aye.
Commissioner Marin,
Aye.
Commissioner Wynn,
Aye.
Commissioner Samples,
Aye.
Commissioner Solomon,
Yes.
Commissioner Woodham,
Aye.
and the chair votes aye as well. With that, thank you, Marnie. Thank you, Doug. I'm not sure if Eleanor and Tammy are back there somewhere or not tonight, but thanks everybody. Thank you, fellow commissioners. Have a wonderful evening, and I guess we'll see you again soon at the joint